Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Chris Harvey of Wells Fargo, the most bullish man on Wall Street. S&P 500 price target of 7,007, and he joins us now for more. Good morning, Chris.
Good morning.
You uncomfortable with that? I want to give you some credit before we start. Credit to you for not changing this call in the tariff storm of early April. So let's start there. Why did you stick with it?
So 9 months in the financial market, that's an eternity. The other thing, we had seen Trump 1.0. We know his style. It's to go out to the nth degree and then to come back in. Furthermore, the underlying fundamentals were still fine, and our EPS and our price target wasn't predicated on a strong economy. What we're seeing is the winners continue to win. The uber cap companies have the higher margins, are gaining more market share. There is a real secular trade in AI that will continue. I was here during the 90s. This is not a fair comparison. It is much stronger and the fundamentals are much better than today than they were back then.
7K is not tariff dependent. It is not August 1 dependent.
No. So people ask, well, what's the fear? The fear is, there's a couple fears. One is, do tariffs start to flare back up? And that's possible, right? We just can't predict that. The other fear, which is a much more real fear, is what's happening with the Fed. Do we worry about the Fed and confidence in the Fed? Because the back and forth between the Fed and the White House, that's not healthy, right? And that can cause problems in the bond market, and that can cause problems with confidence. But overall, we're starting to see M&A activity kick up. We think that M&A will continue to be very, very healthy up and down the capitalization. We do think the Fed's going to cut. Fundamentals are fine. The consumer's okay. And we're not seeing the kind of price increases that people are talking about. We're seeing people say surgical when they're talking about price increases and selectively.
So there's a lot to unpack there, and we'll get to the Fed independence in just a second, right, and what point yields have to rise to before that really triggers some sort of response in equity markets. What about valuations? The idea that you're talking about an 11% gain from where we are right now on the S&P 500 after already reaching record highs amid a wall of worry and, frankly, growth that is expected to slow.
Right. So we talk about this all the time because people say, oh, look at 20 years ago, look at 25 years ago. The S&P is not the same as it was 25 years ago. The constituent in the S&P 500 is much more growthy. It's much more techy. The multiples are much higher. The productivity is much better. The people running the companies are much more attuned, and the acumen is much higher. And so the valuation, yes, it's high, but it's justified in our minds. And again, we don't need to see a whole lot of multiple expansion to get to that level. We're not very far from that level at this point in time.
So valuation concerns don't really spend a lot of time on those. I do want to go to the Fed independence side, though. There is a question of what point yields have to rise to before it triggers true concern in stock markets? Because we've asked that question many times. People give us a level, and then we pass that level, and stock markets shrug it off and say, healthy, healthy, good.
Yeah, it's hard for me to really answer that question. I think what's happening right now is you had Trump come out and say, I'm not going to fire Powell, right? And I think he needs to go out and say that, right? There's a lot of talk and rumors and situations in the marketplace. At the end of the day, we need the Fed. We need the Fed to be independent. We need the Fed to be apolitical, because it is a very important part of our marketplace. And as long as we can do that, that's great. I don't know if rates really have a play in this. I think it's just cooler heads need to prevail.
You read Trump correctly when it comes to tariffs. He put out a truth over the weekend about what Bessent potentially laid out to him when it comes to the market impact of firing Bessent. People don't explain to me, I explain to them, says the President of the United States. Did you take that as him basically acknowledging he understands the negative impacts that could have on financial markets?
I think his team understands. I think he understands. I think if you go back, and one of when we were on the show a while ago, we were talking about, will the feedback loop close, right? Will the administration see what's happening in the capital markets and react to that? And they did. So I do think they understand, but I also think that he feels like he's playing with a very strong hand, and to a certain degree he is. And one of the things we are beginning to worry about is He's looking at tariffs as a revenue generator, right? We have what we have with the deficit and saying, hey, this could be a good way to reduce the deficit. We haven't seen the real impact to the economy. What's the big deal?
In that same truth, he said if it weren't for him, the market wouldn't be at record highs right now. But if it weren't for him, would potentially already be at your 7007 mark.
Yeah, there's a lot of speculation on speculation there. I think we could have done this. Talk in my book, one of the things I said and one of the things I believe is you could have put a 10% tariff on and then just walked away, right? We talked about how there was a seller's tariff and how people, whether it's through Airbnb or Amazon, they understand it. You had Congress, put that 10% tariff on, walk away, and we can do something more productive. But we chose this path, and it's okay. It's a little bit bumpy, but we're getting there.
Might get bumpier. Peter Schiff of Economy. Without the markets pressuring the administration, why would they pull back going into next month?
Well, this to me is the key question. How much is this administration playing chicken on tariffs with the market? If the market's looking past something that hasn't happened yet, does that push them to potentially go even harder because they could extract more, they could offset the deficit concerns from the one big beautiful bill, and there we go.
And you see these countries lining up to really want to do deals and getting a little bit nervous when you have Howard Lutnick, the Commerce Secretary, coming on a Sunday show saying August 1st is a hard and stop deal. Also, he's already telling us what to expect next year. He said, of course, we're going to renegotiate USMCA so we could prepare for more headwinds in terms of Canada, Mexico, and the United States.
It's going to keep coming. It's going to keep coming. Chris, just to wrap it up, the US versus the rest of the world. What have you made of that debate over the year so far?
So we thought that was possible. We thought that was probable early in the year. It happened. Now we're just walking away. We just don't. We're done. We're good. You had that repricing. Now let's go back to fundamentals, and the fundamentals are telling you back to the U.S., back to growth.
Chris Harvey of Wells Fargo. Appreciate it, sir. Let's continue the conversation. Claudia Sahm of New Century Advisors joins us now for more. Claudia, welcome back to the show. It's good to see you, as always. I want to pick up on that speech from Governor Waller, what he said before our conversation with him. Looking across the soft and hard data, I get a picture of a labour market on the edge. Do you get a picture of a labour market on the edge?
That's not how I would characterize the labor market, but I think Governor Waller lays out a very reasonable argument for reading the data. Right, the labor market has some cracks, has some weaknesses to it. I mean, I think they were maybe more apparent last year as the unemployment rate had been rising. But he paints a picture and he ties it to data. Again, I think it's really unfortunate that it becomes wrapped in this conversation of is this a politicized view of his. I don't see it that way. But just to have that kind of injected into the conversation does tend to undermine what he's saying.
Claudia, do you think from your perspective and your years of experience studying the labor market and how that affects Fed policy, do you think that right now a weakening in the labor market really is a greater concern than a prolonged, protracted inflationary push from the tariffs and from strength that we have seen ongoing in corporate America?
So I would agree that there are several threats on the growth side to policies that have been put in place. I mean, tariffs have an aspect of weakening growth through the higher prices. We've seen immigration policy. I mean, there's a whole set of reasons why you'd look out at this year. And we've seen growth slow this year, and that will eventually show up in the labor market. So you definitely can see those risks. And if one, as Christopher Waller lays out, looks at the potential inflation risks and says, these are temporary, we can look through these, then I think it would be right back to where we were, in 2019, where the Federal Reserve faced with tariffs, they cut preemptively. It's just we're not in an environment where inflation is subdued. It's actually been above target for more than 4 years. There are real risks there. We still don't know what the tariff policy actually is. It could be going higher. It could not. So there's just a lot of uncertainty, I think, with the way that the kind of majority of the Fed is lining up their arguments makes a lot of sense. But there is a real perspective, and I would agree that the diversity of thought on the Fed and making those arguments carefully with data, that's a good thing. It is extremely unfortunate, the environment, by having the White House and the president very directly say what they want to see in terms of rates. It's kind of created this, it's made it really difficult for the Fed to have this kind of disciplined data conversation.
And it's even more difficult by the fact that the data is really confusing and it can paint a different story depending on how you read it. I mean, we keep kind of wondering what the labor market is showing us, whether it does show some sort of more dramatic weakening, or whether the housing market is kind of ringing a five-alarm fire alarm saying, hey, we're clearly is a problem. I mean, at what point do you think that keeping rates at this level would really create a weakness that currently hasn't manifested itself in the economy?
We're likely pointed in that direction. I mean, the economy has proven quite resilient. I mean, this is not just talking about this year, but in recent years, the higher interest rates, and there are probably a lot of different reasons for that. But eventually, we do see in interest rate sensitive sectors like housing, we do see these rates weighing down. The reason that the federal funds rate is elevated is because it is trying to push down on inflation. Once the inflation issue is taken care of, well, then there's no reason to have the rates as high as they are, and you should see them coming down. And the Fed tells us that's the direction they're pointed in. They're just not ready to take that move. But there are costs. There are costs in the economy to the Fed having interest rates as high as they are, and we will see those costs build as interest rates stay higher. So, but we're not looking at some dramatic falling off a cliff. We're looking at more of a slow grind, and it does impact certain parts of the economy, certain consumers, people trying to buy homes. Like that is where the effect is. But the goal is to get inflation down. Unfortunately, we've gotten data that it's moving in the wrong direction. That may be temporary, but there's a reason that rates are where they are. It's not, but there are costs.
Governor Waller, though, is looking at these cracks in the labor market. Even individuals like Mary Daly is talking about it's reasonable to expect 2 cuts this year. Claudia, when do you expect the Fed to first move?
So it will absolutely depend on the data as they go forward, but there is certainly a case. And I think, keep an eye on the inflation data that's not connected to tariffs. I mean, I think that's actually been part of the encouraging cases that we've seen some weakness in, some discretionary spending areas, and housing has certainly shown some cooling off. So I think they're building, the data are building the case as long as, the tariff risks don't really move much higher, things really go dramatically sideways. I think they're on track for September or October, as the data come in. And Governor Waller could absolutely be correct that we see some employment numbers that are not as positive as recent ones, and that could move them much more quickly to the cut. But I think the data thus far have supported their let's wait and see. And I think that's where they're going to come down as a group next week. But of course, you can look at the data differently, and they are pointed in the direction of cuts. I mean, some aren't even looking for them this year, but I mean, that's, they have a lot of coherence in what they're thinking. It's just timing is hard. It's just really hard to figure out because timing is hard in the economy.
Claudia, appreciate your time. As always, Claudia Sahm there of New Century Advisors. Charles Myers of Signum Global Advisors has this to say: our base case has been and remains that US President Donald Trump will not dismiss Fed Chair Jerome Powell, at the very least until after the September FOMC meeting. Charles joins us now for more. So Charles, you've given us the best case 2 months. What happens after that if they haven't reduced interest rates?
Yeah, if the Fed doesn't cut at the September meeting, I think the president moves forward with a shadow chair nominee announcement and continues to build the case to dismiss Powell for cause, hoping that Powell will resign. I don't think Powell will resign, but I think that case will continue to be built. What the president really wants is for the Fed chair to resign. And, Powell's not going to do that, most likely. And the other part of this process is the president really trying to socialize with the markets this idea of replacing the Fed chair. The only guardrail working in the United States today in terms of a check on executive power is the bond market. And I think that's what they're most worried about. So the September FOMC meeting is critical, and we'll see what the Fed does. Otherwise, we have a shadow Fed chair.
Well, wouldn't it be even harder, though, for the collective body of the FOMC to cut if he was to get rid of the Fed chair, or say he was going to fire him after the September meeting?
Absolutely. I think, everyone in the markets understands that it's a 12-member FOMC vote. It's not just the Fed chair. But the president sees Powell as the obstacle, and he really wants a Fed chair in, whether it's shadow or if Powell resigns. Even if Powell resigns, by the way, the FOMC picks the Fed chair. So I think what the president's really doing is using Powell as the punching bag for higher rates. He's also worried, I think, that even though the administration doesn't believe that tariffs will be inflationary, that if inflation does pick up over the next several months, you can blame the Fed, blame Powell. But ultimately, I think this shadow Fed chair idea, which even 3 or 4 months ago sounded really far out there or deeply concerning for the markets, is now being socialized and probably happens after September.
Well, the Treasury Secretary talked about the fact that there could be confusion with the shadow Fed chair if Jay Powell doesn't step down after his chairmanship is over, but he still has a governor's seat until 2028. Do you have any indication that he would stay the course until 2028?
Absolutely. I think Chair Powell will stay on the board after his chair term ends, and he stays on the board until the end of his term in 2028.
But wouldn't that look very political, Charles? Charles, that would look incredibly political. Most chairs step down.
Absolutely. But I think it would be a really strong statement by Chair Powell, encouraged by some of the other members of the FOMC, perhaps, as a statement of very strong independence. And that's why I think he stays on.
Charles, there's the question of what happens if, let's say, Chair Powell is fired. And for cause, gets mired in all sorts of legal disputes. There's this issue of, does Congress confirm whoever President Trump nominates to replace him? How much unity is there right now among Republican Congress members?
Well, I think, whoever is nominated has to be confirmed in the Senate. The Senate, including the Republican caucus and the Republican leadership, do take Fed independence very seriously. So whoever's nominated will be a very respectable and acceptable and very positive person for the markets. It'll be one of the folks that are auditioning very publicly for it. But in the end, I don't think that's going to be the issue. That person will get confirmed. The issue is, will they try to sway the FOMC to be more dovish?
Charles Mars of Signum Global Advisors. Charles, thank you, sir. Angelo Zino of CFRA has a buy rating on shares of Alphabet, a 210 price target. Angelo, welcome to the program. That ad model at Alphabet, how insulated is it right now?
Yes, thanks for having me, John. As far as kind of the ad model is concerned, I mean, listen, I think they're doing a lot of great things as far as what's going on across search as well as YouTube, integrating AI across the ecosystem. You've got AI mode ramping here on search, AI overviews. So overall, I think the monetization potential looks pretty good as far as their ad-based businesses and AI integrating across that ecosystem. Clearly there is a risk as we kind of go on here over the next couple of years. Eventually, OpenAI and others out there will probably have some sort of ad-supported models, and that is, clearly a risk here for Alphabet. So, sitting here today, I mean, we do think their ads, Google's ad-supported businesses probably grow around in line with the broader digital ad market. Let's call it high single-digit growth. But, ultimately, as we kind of go into some of these forward-looking years, 2026, 2027, we're looking at the growth pace of, something like search to grow at about half the pace of the digital ad market, just because they're going to have some, increasing competitive pressures out there.
Angelo, are we underestimating the speed of the adoption of OpenAI, of ChatGPT, and some of these algorithmic models that some people find superior to the classic search model? I mean, I was listening to John and Mandeep talking, and I'm thinking to myself, I've known so many people over the past 6 months that have utterly transformed their workflow because of ChatGPT. Is the time frame a little bit faster, potentially, than what we're talking about?
I mean, potentially. I mean, I guess we'll see here. I mean, ultimately, people are doing search in a different way than they have historically. And but when we think about just overall what Alphabet has, across their ecosystem as well, I don't think it should be underestimated. I think Gemini is an enormously powerful tool. I mean, I'm personally a power user of Gemini. I do love the fact that it's across their entire ecosystem out there. There is an advantage out there to that. I think that Alphabet's getting extremely smart with Gemini. So, I don't think you can completely dismiss Alphabet specifically and what they're doing across the AI ecosystem, not to mention their infrastructure, I think is better than just about anyone else's out there. But again, that being said, I mean, maybe to your point with what OpenAI is doing with ChatGPT and others out there as well, there are going to be more options out there in the market. And that is something that I think, as an analyst, you can't underestimate, and you do have to factor that into your future assumptions. But we do expect ultimately their ad-supported businesses to continue to grow. It's just not going to be at the pace that, maybe you're seeing from, the market here over time because of the broadening out and greater competitive pressures.
A couple of months ago, there was a skepticism on Wall Street about the amount of money that hyperscalers were spending on R&D, on CapEx. And there was this question of, are they overspending? Meta had said, we can't spend enough. Do you think this season you're going to see a rewarding by investors of companies that increase their CapEx spend dramatically? Or do you think that that's going to be treated with the same skepticism as a couple of months ago?
Well, I think what you're actually going to see this earnings season, I think you're going to see CapEx spending plans sustained and not increased. We actually saw Meta increase it last earnings season as far as their 2025 CapEx guidance. I think, Microsoft has actually done a pretty good job here over the last couple of quarters, essentially kind of flatlining the CapEx number, leveling it out. This is their year end, so we'll kind of see what type of guidance and outlook they decide to provide here for investors here over the next year. But I actually think, for the most part, you're going to actually see more favorable return ROI metrics across kind of some of these cloud providers because of how they're spending on the CapEx side of things. They are shifting more towards the server side of things here over the next couple of quarters and years. And clearly the growth pace is, starting to kind of decelerate and level out a little bit here. So I think kind of the return on investments are going to see considerable improvement here, not only over the next couple of months, but over the next couple of years. And I think investors will reward that, maybe to your point. I think the other important point here, or item to look out for here this earnings season, is something along the lines looking at the OpEx side of things, something that these companies have really been holding, kind of leveling out here over the last couple of years. Actually, if you look at employee headcount, whether it be from Google, Microsoft announcing recently some of their headcount reductions, essentially down over the last kind of 2 to 3 years, flat to down. And I think it'll be interesting to kind of see how all these companies comment relative to what we've seen here from Zuckerberg over the last couple of weeks and months. I think that's going to be really an important storyline as well.
Angelo, appreciate it. Angelo Zino there of CFRA.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.